Okay, so good evening, everyone. So this is the beginning of this session today. Can someone confirm me in the chat that you can hear me and see me, please? Good morning. Hello, 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 Tuanhan. Hello, me. Okay, so it sounds good. So before I forget a few things, so do not forget, I can see it's the case for most of you. I didn't check if someone was not like this, but it seems it's okay. But just in case, just be sure that your name, no, I think there is one student or three students for which it's not the case. So please rename your name, group with the number of groups, then your name, okay? Because in 1 hour or so, we will go into breakout rooms. So to be able to split the students among the different rooms, I will use the name, the number of the name, okay? So please check this. So I think it's okay for nearly everyone, but so maybe one or two. You can just rename your name, right? You go you go on your little square, and you have the three dots, and you can click on the three dots and click rename and just rename your name, okay? So also I posted some documents yesterday, but we will talk about that later. So actually, so we're coming back to what we were doing. Okay, so firstly, we were talking about the fact that instead of keeping the machine year 5, we were selling the machine year 5, okay? So in that case, we have a problem, sort of, in terms of calculation. So we have to change the cash flows of our project. So this is what we do with HomeNet. Because actually we have to be careful about the fact that we're gonna have two cash flows. We're gonna have to calculate what we call actually the after-tax cash flow from asset sale. Okay, because in terms of cash flow, what's gonna happen is we're gonna receive the selling price, okay, but we're gonna pay the tax on the capital gain. Okay, so if we sell the machine, like it was supposed to at the end of year 4, so we have to take that into account as additional cash flows in year 4. So selling price in addition, and tax gain, the tax on capital gain in minus, okay, negative. So of course, what we do usually, we take one amount, which is the difference of the two. So we need to calculate. So the selling price was provided. It was said to be 2,000. So that was not a problem. The problem was to be able to calculate actually the tax on the capital gain. Okay. So firstly, the first thing we had to do was to calculate the net book value. Okay. So we are at the end of year 4. So we have a machine that we bought for a price of 7.5 million, okay? And then we have 4 years of accumulated depreciation, okay? So that means that we have 6,000 of the accumulated depreciation at the end of year 4, okay? Which is actually clear, because we remember that in year 5, the only thing that we consider in year 5, it's a depreciation, right, on the machine. So this is the depreciation that did not happen, that we have now at the end of year 4, 1,500. Okay, so the book value, the accounting value, the residual value of the machine when we sell it, it's 1,500. Okay, so our gain is the difference between the selling price, 2,000, and this net book value, 1,500. Okay, so the gain is 500. And then now that we know the gain, we can, okay, so there is a mistake with the tax rate here, so maybe I'm gonna check in the Excel file. So I have to show you my Excel file. I have two Excel files actually. Which one is it? I think this is this one. Just checking that. Okay. Yeah. Sorry, I was hiding the chat, so I was afraid that I forgot one question to answer to. So okay. So where is it? Okay. So what I did, sorry, what I did myself is that I created additional tabs with these additional scenarios, so I can keep, you know, the result we had together yesterday, and then create, you know, just copy and paste the results and then change what we have to change. But you can do what you want. So yes, what we were saying is that we have a tax gain of 500, okay? So sorry, there is a little mistake in the slide about the tax rate. It says 0, but it's 40%. So the tax on gain is of course 200. It's 40% of 500. So it means that if you remember what we say, on one hand we're gonna have a cash inflow of 2,000. So we receive year for 2,000 and we pay 200, okay, to the government. So the after-tax cash flow from asset sales, which is actually the net. So that's the net cash flow, okay, of this cash flow of selling the machine is 1,800. So we have to add this to the cash flows of our project. Okay, so I come back to this, sorry, I come back to this one. Okay, so you should see my Excel file, hopefully. You tell me if you don't. So I just recreated the upper cash flow here that we had. So I just copied that, right? Just copied that in the upper part of this document. So everything appear in the summary, okay? What I didn't do yesterday in the other Excel file, because I just say this line is equal to this line to save some time, I guess. Okay, but it's better if you show that, especially for your group work, you know, because on one slide, on one chart, in one table, we can see the summary of the calculation of the cash flow. So I invite you to have this summary completed and made clear when you do your group work. Maybe that could be certainly one of the slides that you will show to us once you explain your assumptions. And so what is new in this version is that I added a line that I called plus after-tax cash flow from asset sale, okay? And so I have 1,800. Maybe I'm not gonna fill that, I'm just gonna fill this so it's more clear. Okay, that's it. So now the cash flow is 9,000 here. And the other thing that you had not to forget was that you don't have the depreciation in year 5 anymore. Okay, so maybe you forgot that. No depreciation in year 5 because you sold the machine. Okay, so this cash flow is also different now. If we compare with what we had yesterday, we had 7.2 and 2.7. Okay, we had this and this also plus depreciation. Okay, now all this disappeared. So we don't add back the depreciation because there is no depreciation anymore. Okay, and we added a line, okay, which is 1,800. So you cannot trust the number of the line anymore, I guess, because maybe we don't have the same. And so when you have this, you have actually taken into account the calculation of the NPV in the context of you sell the machine instead of considering that the machine, you keep the machine, you let the machine depreciate for 1 year. So that's what they do in the book. It's not really realistic, right? Because usually we try to find a way out for the machine or for the end of the project. So the first approach would be to say that we consider we sell the machine. Okay, so you can do that also for your group work. You can consider that at the end of the project, you sell the machines and you show your calculation. Okay, maybe you change the tax rate to make it Vietnamese. Maybe I don't know. As far as I remember, it's 25%, but maybe it changed or maybe I'm wrong. And that's it. And so you have the NPV. So in that case, we find that the NPV is a little bit higher. Yes, of course, because we sell the machine, so we receive a selling price. Okay. I think just for you guys to know, it's quite big, huh? The NPV like this, 6 million when you invest 7 million, 0.5. You know, it's quite big. It's quite optimistic. Okay, so I don't expect some NPV like this. NPV positive, it's already a good thing, and the IRR, if it's like between 10 and 20%, it's okay. 25 seems a little bit high, but anyway, it depends on your assumption. Okay. So that's it for the selling of the machine. So do you have any question about this question? Just waiting 5 seconds, 10 seconds, and I move to the next topic. Because I've been able to see that sometimes it takes you a few seconds to write down the question. So I think there is no question, and the question, you know, arrives afterwards. So I'm just making some blah blah, talking, chit chat. So to wait for the. So by the way, I'm sorry I didn't take a picture of the snow because the snow didn't last. So it's not Santa Claus so much. It's just cold. So I'm sorry. It was not dreamy. It was not nice. So I didn't want to show something which is not nice. Okay. So still no questions. So I think I can go back to the PDF document of the slides. So I'm going to share that. Okay. And so we're going to move to the next scenario. So you should see the PDF, the slides, right? And you should see a slide called further adjustment to free cash flow, continued. And now we talk, instead of considering that we sell the machine, we consider that we're going to take into account a terminal or a continuation value. Okay, so it's like what we did the first day, you know, when we did time value of money. We had this company, this hot internet company. When we calculated the value of the company, it was like for the 5 first years, we had a growing annuity. And then from year 6 to the infinite, we considered a growing perpetuity that we, you know, discounted back to year 0 to add to the present value of the growing annuity. So we add the two and we find the value of the company. So here it's the same thing, I guess. What we can say, we can say that for the machine we calculated, we can consider, let's say that the production is not stopping after 4 years, and that it's gonna go on. Okay, so this is what we say here. And so, okay, I'm gonna go to the version without solution. Yeah. So this is the one you have. So in that case, we just have to add at the end of in year 4 and year 5, depending on the assumption, the present value of the growing perpetuity or growing annuity that we consider. So here, it's quite simple. So we will consider that the free cash flow year 5, okay, it will be 200 because volumes are falling and the machine is old, okay. Then the terminal value from year 6 to the infinite is a growing perpetuity that we calculate year 5. Actually, if I remember well, let me check, but okay, so so sorry, there is a, okay, so there is a little mistake here. It's so the free cash flow year 5 is 500, okay? But the terminal value from year 5, it's 5 here, to infinite is a perpetuity that we calculate at the end of year 4. Okay, so you just change this. And no recovery of the working capital in year 5, okay? Because, yes, that's correct. Because you the recovery of the working capital is when you stop producing. Then you receive the money from the customers. After you stop producing, you don't need to have inventories anymore, and so on. But here, if we consider that we continue to keep on going producing forever, then you don't have to consider the recovery of the working capital in year 5. Sorry, I say usually working capital with a K. I know that people usually say with working capital with a C, but anyway, well, whatever. So that's working capital. So I would like you to calculate the new NPV under that scenario. So you consider that the free cash flow year 5 would be 200, and that will grow at a rate of 2%. Okay, so that's a growing perpetuity. So you need to calculate the present value of the growing perpetuity. It's from year 5 to infinite by calculating year 4. Okay, so here I'm going to change that. And so I let you a few minutes to do it in Excel. So same thing here. I invite you maybe to take the first result that you have, the one we did together yesterday, and copy paste and create a new tab, and renaming the new tab with terminal value or continuation value. And so you can calculate things. Okay, do you have any question? Okay, so I let you 5 minutes to do it. And please correct this because I already sent the slide with solutions. So maybe I'm going to change that, but okay, we see. So I let you work, and I'm going to change my slides already. So two things I can say. The first is that you have the new version of the assumptions now on your screen. Normally, you can see them. And the second thing is that I made a mistake, like on Sunday, I stopped recording and record again. So you will have 2 files for today. And I think you will have 2 files. And I don't know if I will certainly stop to record when we go in breakout rooms, because I think it's not useful for you to have this afterwards. Then you have the solution. But okay, you have the solution. So you know what you can reach, but no big deal. Okay, I've been able to hide the solution, so you don't have the solution anymore. So when you have an NPV to propose, you can propose it in the chat, so I can see when some of you guys are finished. Because again, I'm blind here; I cannot see you working. So that's one of the defaults of the online thing. I don't know when you are finished. So please do not hesitate to share your solution in the chat. No, it's more than that. It's more than that. It's high. It's more than that. It's strange that you have so little NPV. It should be around, like, not so different from the one we had yesterday. So so the it depends on what you have. 2040. Are you talking about the NPV, or are you talking about the terminal value? Yeah, actually, I have 2000, right? For the, so yeah, I have 2000. So I think, Chung, you are talking about the value of, let me check something. I think, Chung, what you are 1135 maybe could be the present value of the growing perpetuity. So the growing perpetuity, the value of the growing perpetuity is 2000. You should find 2000. 2000 normally. And the new NPV should be 4,766. 2000, yeah, 2000. So I don't know, Kian, why you have 2040. So, okay, I understand. It's because FC5 is already, it's 200. You don't have to make it 1 plus G. So you can make, it's 200 divided by I minus G. Okay, because what they say in the case is that 200 is already the free cash flow year 5, right? So it's already taking into account the 1 plus G if you want. Yes, we have to do it, 200 to the present value, but it's not 200 that we have. Yeah, we have to discount the 2000 to the present value. Yeah. So that's why I understand that the 135 is what you did, but that's why I didn't understand what the 135 was. So yes, we have to discount it to the present value. So that if you made it out of the chart, it's okay. It's me that I just added the 2000 in the cash flows of the project, and then only I calculated the present value. So for me, if you want, I didn't calculate the present value of the 2000 separately, but you can do it that way. You can say, but you have to be careful not to let in your in your Excel file things that do not happen anymore, like the recovery of the working capital year 5, for example. Okay, so maybe we can look at it together because I see already some solutions, but nobody has the solution. So let me show you the way I solve that. So maybe we can discuss with the result. So now you should see the Excel file. Okay, so firstly I calculate the growing perpetuity. So the growing perpetuity in year 4 is equal to free cash flow 5 divided by R minus G, right? So let me reduce a little bit. Okay, like this you should see. So yeah, I just say that for Kian because I understand what you did, Kian. It's correct to do so. But if you say free cash flow year 5 times 1 plus G divided by R minus G, it means that you consider that the first cash flow you consider is the free cash flow of year 6, right? Because you consider that the free cash flow of year 6 will be free cash flow of year 5 times 1 plus G. In this case, it's a little bit simplified because we want to calculate the growing perpetuity in year 4, and the free cash flow in year 5 sort of already includes the 1 plus G when I provide the 200, because it's already the free cash flow year 5 which is provided. So you can just do 200 divided by R minus G to find the growing perpetuity year 4. Okay, so growing perpetuity year 4 will be equal to 200 divided by 12% minus 2%, because 12% is our discount rate and 2% is our growth rate. Okay, so that means that the growing perpetuity that we find in year 4, that represent all the cash flow from year 5 to the infinite, would be 2,000. Okay, and so what I chose to do is to just add it to the cash flow year 4. Okay, and be careful, there is no recovery of the working capital in year 5 anymore, because we consider that, you know, the project is continuing till the end of the times. So we don't need to consider that we recover the working capital anymore. Okay, so I just add 2,000 to the last cash flow, and I don't have any cash flow in year 5 anymore. And so my new NPV is 4,766. And Chung was saying, don't we discount 2,000 in the year 0? So I guess Chung was doing this 1 plus 12% exponent 4. Okay, why does it not work? Why does it not calculate things? Maybe because I'm in English, and then in English the exponent is not the little hat anymore. Okay, that divided by 10, does it work? No, it doesn't. Okay, no, it's the format of my cell, certainly. So I'm going to try to go here, divided by 1 plus 12% exponent 4. So you, Trung, so you found 1,135, right? And I have 1,271. So I don't know why. Maybe it's because you did it in year 5. Yes, you did it in year 5. Okay, so see, I can find how you did it. Okay, so that would be correct, but you have two mistakes. The first is that the exponent, you should take exponent 4 instead of exponent 5, because the present value is calculated year 4. So if you discount today, it's exponent 4. Okay, so it can work this way. You can do that this way, but do not forget also that the increase in working capital is not there anymore. So you shouldn't have So you cannot just add the 1.1 or the 1.271 to the NPV you had before, because there is another change which is linked to the increase in working capital. So that's why maybe the easiest way to do it, I guess, is just to copy paste the previous result and change the assumption which are in yellow here to recalculate the NPV. Is that okay, Tran? Or is it okay for everyone, or is there any question? Just for me to know if it's okay and if I can move on. Or if you have any question. Can you explain again about terminal value? Okay. So, okay, I say everything again, okay? No, this one is not correct. Okay, so okay, so this is what you should have. Okay, so we consider that the free cash flow in year 5 will be 200. Okay, because volumes are falling and the machine is old. And the terminal value so we calculate the terminal value from there. It means that we consider that we're going to have 200 that begins here, okay, and that's going to be growing by 1 plus g from 1 year to the other, okay. 200 times 1 plus g, 200 times 1 plus g square, and so on and so on. Sorry, it's not easy because the cell are not maybe even I don't share my Excel. I don't remember if I share my Excel. Okay, so that would mean that you have 200 here, 201 plus g, 201 plus g squared, 200 times 1 plus g exponent 3, and so on and so on and so on. Okay, all those cash flow from year 5 to the infinite, okay, we would like to take that into account. To do so, we calculate a growing perpetuity, okay? And so the growing perpetuity will be to take into account 200 from year 5, 6, 7, and so on, okay, till the infinite, okay? So we can take that into account. So the way we do it is just to take into account the growing perpetuity. So we say that we take the cash flow of year 5, and that cash flow will grow by 1 plus g. So we do cash flow year 5 divided by r minus g, and so we calculate the growing perpetuity. But when you have a growing perpetuity or a growing annuity or something like this, if you have something like 1, 2, 3, 4, 5, for example, okay? And so you consider that the first cash flow in 1 year, it's 200. Then it's 200 times 102. Then it's this one times 1.02. And so on. So this is what we have, okay? This is what we have. Okay, so in our case, the year is 5, 6, 7, 8, 9, okay, and so on. This is what we have in HomeNet, okay? We consider that we have this year 5. So year 5 we have 200, year 6 we have 204, year 7 we have 200, and so on and so on, okay? So the terminal value will be calculated 1 year before, okay? This is when the terminal value will be calculated, okay? So the terminal value in year 4 will be equal to free cash flow 5 divided by R minus G, okay? like in every example, when we calculate the PV0 is equal to C1 divided by R minus G. Okay, so the present value is always 1 year earlier than the first cash flow that occurs. Okay, so when you have, for example, PV0, which is calculated for any circumstance, it's going to be C1, okay, divided by R minus G. So the first cash flow we consider for our calculation, okay, is actually 1 year later. I can understand how to calculate, but still confused about the definition. Okay, so the terminal value or continue. So that was just in case we had a mistake in understanding which year we are in. Okay, so this is what I wanted to say. So terminal value, in terms of definition, is actually when you consider that you want to take a sort of a global assumption for what's going to happen till the end of the times, okay? So it's like an approximation, okay? So terminal value is a residual value of the machine at the end of year 4 that takes into account the cash flow we should receive from the machine from year 5 to the infinite, okay? So this is how it works. And usually this is what we do also when we evaluate a company. We say that in our project, for example, we have the 4 years during which we have something, precisely calculated, okay? But then we can say that, okay, in year 5 and then after year 5, we have to consider that there is still a value that we have to take into account in our calculation, but we cannot calculate that precisely because it's far in time. So maybe some things will happen in between, so we don't know. So what we do is we take into account the terminal value. Terminal value is a residual value of the machine at the end of year 4. Okay, so we can consider a value of it. And it takes into account all the cash flows we can expect to receive from the project from year 5 to the infinite, which is an approximation. And we have it through the growing perpetuity. So this is what the terminal value is, or a continuation value. This is the same. Okay. Yes. So one last thing about this. In the case of a project like this, so in the case of a company, when you evaluate, yeah, you're welcome, Trump. This is what I'm here for. Okay, so what I wanted to say, one last thing which is important, I think. What I did, like terminal value with a growing perpetuity, so we consider that the machine will last forever, right? I'm not sure it's an approximation, so maybe it's not very precise. It's okay for a company because when you want to evaluate a company, okay, like we did for the hot internet company the first day together, it's okay to accept that we have the growing annuity during 5 years and then the growing perpetuity for year 6 to the infinite because the company is supposed to last forever, okay? For a project like this, for the terminal value, so we took a growing perpetuity, but maybe it could have been even better to say this project will last 5 more years instead of perpetuity, 5 more years. And so we take a growing annuity from year 5 to year 9, and we add it to our project. I think it would be even better because it would be more representative of what we can have for a project. Well, I'm saying that because I remember that at least one group did that in the group work some year. So, feel free to even to steal the idea if you want. Okay. Coming back to the slides. Coming back to the slides. So we finished with this terminal or continuation value. Okay. So basically what we discussed today is how we can take into account the end of the project. Okay, so we consider that we can sell the machine, or we consider that a terminal value that could be a growing perpetuity or a growing annuity. Okay, so please keep that in mind. Now let's finish with some extra analysis about the project. So firstly, what we call the break-even analysis. The break-even analysis is actually to try to find the levels for which the NPV is equal to 0, okay? So you can do it one parameter at the time, okay? For the units sold, for example, we can say we go in the project, okay? So I'm gonna share the Excel again. And I'm gonna come back to the initial assumption when we have 5,027,000, okay? And I go there and I say, okay, with 100 quantity, I have a NPV of 5 million. What about if I have like 90,000 product sold per year? What's the NPV? So it's 2.5. Okay, what about this 80? It's 61, so not so far from 0. So we know that, you know, if we did our job quite well, we can know very quickly what is the minimum quantity we need to sell to have a positive NPV. Okay, so it begins to give us a sensitivity about our project. Then we go back to 100 and we change the assumption for the selling price per unit. What if we sell only 240 instead of 260? Okay, we still have a positive NPV. 230, we have a negative NPV, so maybe it's 234, 233, 231, 232, sorry, and so on. And so you can play with the numbers, okay? So we are not so far from 230, 232. So it means that the break-even point in terms of selling price per unit is 232. So when you do a break-even point analysis, you change only one assumption at a time. So that's why you say, I came back to 100 for the quantity to sell. And you see for each parameter, what is the minimum value you should have if the other parameters are held constant, okay? So you can have a better understanding of your project. And so you have some values for the whole net project. So more precisely, 770,759, 232 per unit, 138 per unit for the cost of goods, and of course the cost of capital, the break-even point for the cost of capital is of course the IRR. Okay, so you have it already. So here, please change one parameter at the time. Okay, so you can see what is the value you can have. Okay, so that's the first approach, break-even analysis. Certainly, you can sophisticate the formula in your Excel, so it goes automatically, but I don't have the time to see that. And so that brings me to what is important also for you to know. It's what we call the sensitivity analysis, okay? It shows how the NPV varies with a change in one of the assumptions holding other constants. So it's a sort of a break-even point that goes further, okay? So for example, we could say that we take these parameters, number of units, selling price per unit, cost of goods sold per unit, working capital, cannibalization rate, cost of capital. And so here we have the initial assumption. So this is what we have in our chart, okay? Then we can imagine a worst case and a best case scenario. So in real life, this worst case and best case scenario would come from information we gather in the firm, okay? We go and see the marketing department about what could be, in their opinion, the most optimistic scenario for the quantity to sell, the worst scenario, and so on, okay? And you can do that for the different thing. So to have a sort of not a unique NPV, but a range of NPV that goes from the most pessimistic scenario to the most optimistic scenario. And my advice is that you do that parameter per parameter, one parameter at a time. So you can isolate the influence of one parameter at a time, okay? And here, this is a chart that I like very much. It's actually the illustration of what is the value of the NPV for any parameter if we go from the worst case scenario to the best case scenario, okay? And with the initial assumption in the middle, okay? So we can see that here we have the line where the NPV is equal to 0, okay? So it means that everything which is on the left of that line is a negative NPV, okay? So we can see, and so this chart is very interesting because it shows which parameters are the most important to look after. For example, the net working capital, if our initial assumption is not good, okay, about the percentage of receivable, the percentage of payable, whatever, we don't care. We don't care because, you know, if we make a mistake in this assumption, it's not going to change NPV very much. It's not, the NPV is not sensitive to that parameter. So if we are working in a company, we are paid for that, and our boss is asking us to provide a result by the end of the week or something like this. Thanks to this chart, we know that it's already not useful for us to spend time on working on different assumptions for the net working capital. We don't care. It's not going to change the result. On the contrary, of course, it seems that one parameter which is very important to master, the most sensitive in this project, is the quantity, okay? Because it's the only parameter for which the worst case scenario leads to a negative NPV. So it means that in this case, for that parameter, the number of units we sell, okay, if we make it wrong, if we have if we are not good precise in the estimation, and the reality is different, then maybe the company can lose money. Okay, so what I would say is that once we have this sensitivity analysis, which is done for this project, we could say that maybe we advise our company to take a few more weeks, for example, to investigate more about the assumptions of the quantity, okay? To go more for, further research about marketing research, about the potential quantity that can be sold, what is the market share that we can obtain, and so on and so on, to be sure that our assumption is reasonable with 100, and that the risk that we are below 79.8 thousand units is not so big, okay? And of course, selling price per unit seems to be a sensitive parameter. So graphically, we can see, right? The more spread we have the line, of course, the more sensitive is our parameter. So it can be also interesting for us to discuss the fact that, okay, which parameters are more sensitive to our project, okay? So usually students, they don't have the time to do a chart like this for the group work. So don't worry about that. It's not required. But a sensitivity analysis can be done, okay? And we can show the result in terms of number of dollars, maybe more than in a graph. And I think we are finished with the with this. Okay, so maybe we can just have a look at the group work rule. So do you have any question about this chapter? Sorry for the little mistake about the assumption in the terminal value. I hope you understand still. Any question? If not, I'm gonna just show show again the group work rules document. Okay, so I can show the group work rule document. Okay, so we discussed that a little bit more. What is table 8.6 about NPV cost of outsource versus in-house assembly of HomeNet? It's something I wish I have time to do, but every year I don't have time to do. So it's not something that is required for the exam because we didn't discuss this. And what is it about? You can still have a look at it because you have the solution, so it can be useful for you later on. It's actually how you can use the NPV calculation to compare two strategies within the company. So in this example, table 8.6, what they look at is that they say, okay, HomeNet product, we can buy it from the outside, $110 per product, or maybe we can imagine that we can manufacture it ourselves. And so we have to consider what is each of these two scenarios. What if we outsource? what if we buy that from the outside? So it's 110 versus if we manufacture in-house. So maybe it's going to be less expensive in terms of raw materials, but maybe we'll have some employees to pay and so on and so on. So what is done in this part is to take assumptions about what happens if we outsource versus what happens if we manufacture in-house, and then to compare the NPV of these two solutions. And so the NPV are usually both negatives. We can have a look if you want. We can have a look, and you can look at your look by yourself later on if you want. Okay. So in the Omnet example, we assume that the company could produce each unit in-house for $95, okay, instead of buying it 110 to the outside, okay. That would mean that the company would have to have 5 million upfront cost to consider in this scenario, okay. The in-house manufacturer will also require additional investment in inventory equal to 1 month, to 1 month's worth of production, okay. So we consider the two solutions, or we manufacture ourselves or we outsource. And then we try to compare the two. So if we outsource, so we pay 110, okay. We know that we have accounts payable 15% of cost of goods sold. We know that we have, that's it. So we know the influence about the net working capital. On the other hand, if we do in-house, so we have a cost per unit of 95 instead of 100, but we have additional front cost of 5 million. And what else? Well, we have 15% of cost of goods sold in the accounts payable, but it's not for the same price anymore. It's 95 instead of 110, okay? And we also have an additional influence for the working capital, which is 1 month of inventory, okay? And that's it. So we can see that what we have to compare between the two is that the difference in the cost, right? 95 versus 110, but when you have 95, you have 5 million at the date zero in addition cost. And we have some difference in the working capital because the accounts payable is not for the same amount. It's 15% of the cost of goods sold, but the cost of goods sold is 110 versus 95. Okay, so it changes. And when we have in-house, we also have an additional inventory to build. Okay, and so what we do usually, it's very interesting, but it's not so easy, so it takes time. So it was like 1.5 hours additional time to compare the two. And so we see this is the NPV of outsourcing. Okay, this is the NPV of outsourcing versus this is the NPV of in-house. And both are negative because we are comparing two costs, right? So the cost of outsourcing is 110 times the number of products, okay? Or the income tax, which is incremental, the difference in the working capital. So the cost of outsourcing is 19.5 million. And if we do in-house, we can see that we have 5 million additional here, okay? Because we have 5 million of cost upfront, but we have less cost afterwards because it's $95 per unit instead of 110. And we got a little bit difference in the working capital because we have inventories to consider as well. And so we calculate the NPV of that thing. It's 20 million. And so thanks to this, the company is able to say that if the calculations are correct, it is more expensive to do in-house because it costs 20 million than to outsource 29.5. So if we want to decide, is it better for us to manufacture ourselves a product or to outsource that to another company? It sounds like it's better for us, financially talking, to outsource, okay? So on a financial point of view, the cost is lower to outsource than to manufacture ourselves. Then afterwards, of course, you have to consider other information such as, is it better for us to manufacture ourselves so we can be sure about the quality of the product, we can train the employees to do the products the way we want. If we do it ourselves, maybe we are less dependent on the supplier, so the supplier will not be able to raise the prices or whatever, even if we still buy some raw materials here, but so the prime is just displaced. But at least for the quality of the product we manufacture, of course, we have a better mastering if we do it ourselves versus if we outsource. Okay, so this is, yeah, thank you for the question, actually, Dong, because usually I don't take the time to do it with the students because it takes too much time. But finally, I realized that maybe it's not necessary that you do it, but I can just explain the main principles. You still have the Excel file that you can do it by yourself if you want to know more, but at least you understand what is behind this choosing among alternatives, which is very interesting. It shows another use of the NPV calculation. It's not about should I invest in one project. Here, it's about comparing two, let's say, two strategies, right? Manufacturing ourselves versus outsourcing the production. Does it answer to your question, Dong? So yes, I can understand the concept now, but it is fast, so I cannot understand deeply. Okay, so you can still do it by yourself afterwards because you have all the solutions, right? And you have also in the Excel template, you have also the template you can try it by yourself later on. Okay, so you have a better understanding. But again, since I don't have the time to do it in a deep way, it's not something I can ask for the exam. Okay, maybe a theoretical question, but not calculation because we didn't spend the time together. Okay, so consider that as extra knowledge. Extra knowledge. Is there another question? How do we forecast the inventory? You mean in your group work, for example? If it's in your group work, for example, okay, so I would say that you have to make an assumption about number of days. Okay, you say that you need 1 month of inventory. This is what I would do: 1 month of inventory, or half a month or 2 months, depending on what you have. That's first thing. And then if it's 1 month of raw materials that you want to have, okay, then you will take the cost of goods sold that's the way they do it here. Actually, they take the cost of goods sold, 9.5 million, and they say that you need 1 month of inventory, so you just take 9.5 divided by 12, and this is the amount of inventory you should consider in your working capital. Okay, so that's it, under the assumption that you have inventory of raw materials. Okay, if you want, so that's for raw materials. If you want to have in addition inventory of finished goods, it's more difficult because raw materials, of course, you can just take into account the cost of goods sold. If you want to consider the production cost of finished goods, you should take into account extra costs such as which ones? No, not even, because okay, no, let's make it simple. You have only one kind of inventory because we have only the cost of goods sold. The other costs are selling, administrative, and general expenses. I'm not sure I would take that into the component of the stock. So I would say that if you want to consider an inventory, please consider only one sort of inventory using the cost of goods sold as your benchmark for calculation. I think it's more simple this way. It's a little bit simplified, but the way we have the information in HomeNet, I think this is the only way we can do it. Is that okay, Han? Okay. Other question? Okay, so let's just share the group work rules. You must see it now, I guess. Okay. So in groups, you must prepare and present a capital budgeting work about a project that you choose, related to your professional environment or recreated out of the assumptions you will defend. So think about it in a group. Okay, what could it be? The product, and then you have to create, to calculate, to go to the NPV and IRR calculation. But this is not the calculation which is the most tricky. The most tricky, I think, it's about the assumptions you have to consider. You have to consider what is the quantity you would be able to sell, what would be the selling price, what would be the cost. So all the assumptions, this is what's going to be tricky for you to do and what will be interesting. Okay, so then you will have to present your project during 15 minutes, maybe more, because we have 4 groups and we will have sort of 2 hours. Okay, so you can prepare a little bit more than that, and we will have question and answers anyway. So it's going to be like, you know, between 15 minutes and 30 minutes, including the questions. Okay, maybe you can prepare 15 to 20 minutes. And so with the questions, it's going to be 30 minutes. Okay. So what you have to do firstly is to present your project. This is what people do already. So you present what is your company, why you should invest in a machine, what to do, why is it incremental, why is it different from what you do already. Okay, and then you try to show to us what would be the assumptions about the revenues and the costs. Okay. Depending on the project, if you can find an assumption about some cost which is related to your project, cannibalization, other externalities, please do, okay? Like you have this new product, but there was an old product which is quite similar, so we are losing cannibalization, blah, blah, blah. So you try, just the idea here is just to show that you understand how it works, okay? So of course, working capital requirements, but I guess you already thought about it because you're asking questions about inventories, which is interesting because we didn't have inventory in the ONNET project. So for the opportunity cost of capital, or WACC, I answered to that question yesterday already. So we said that a first approach would be to try to find the cost of capital of a similar project. So within your company, with the competition, or to calculate one. So, and if you did that in your past, you can do it. You can try to calculate a WACC, or you can try to calculate a risk-free rate plus a risk premium for your project. Okay, so that could be interesting. Then you show the calculation of the NPV and maybe other indicators. I would say at least IRR, maybe discount payback or something like this. And then you conclude saying that you decide to undertake the project or not. Usually, but it's no big deal, but usually people reach a positive NPV, but sometimes the NPV is too big because maybe if people forget costs. So really, my advice is that you split the job between you guys to, to separate everyone doing one part of the job. And so you consolidated the assumptions, and then you can try to calculate the income statement already, and then the free cash flow. Of course, if you have a sensitivity analysis, this is a plus, okay? I don't need the chart, but maybe, once you finish the NPV, try to calculate what if we have this, what if we have that, minimum, maximum scenario, and so on. That could be a plus for your project. So usually I say that, but it's up to you. Please limit your calculation to 3 years of production, years 1 to 3. So maybe sometimes people do more. It's just that sometimes, if you have 10 or 20 years, it's not easy to show in an Excel file or in a PowerPoint document. Okay, so the presentation will, consider investment and other upfront costs made in year 0. So yes, this is my advice. Consider that the negative costs are year 0, and then positive cash flows come afterwards. So you will avoid to have an IRR and an NPV that do not go in the same direction. And consider recovery of the working capital salvage value in year 4, or yes, you can do this, or year 3. Finally, I don't care. And so you can consider, yes, a salvage value, terminal value, selling price of the asset, or nothing, depending on what you consider is the most appropriate. So the presentation will be followed by a question answer session. during which the professor, but also other students, will be able to ask further information about the points that need to be clarified. Okay, so everyone can ask question. I know that sometimes people do, sometimes people don't, because they know that if they ask questions, then the group will ask question to them later on. Okay, but still we can do it, we can try. Okay, it's online, so it's different than the previous years, but I think we can do it. What will be good then is that we cut the mic to everyone, but then you just connect your mic if you want to ask a question. Each group will receive a mark that counts for 30% of the final mark for your course. Okay. Each team will have to send its document to the professor at the due hour. So it means that tomorrow, after 1 hour of session, or Saturday after one just before the presentation, everyone should send me the presentation to, let's say, this address, to make it simple. You can also send me the Excel file if you want. And for the presentation, same thing. It's a PowerPoint presentation, but keep the Excel file ready because certainly in a lot of situations, I will ask for further details for calculation of some topics. So my advice is also, when you present your project, present your key assumption, the context of your project, the calculation. Okay. Maybe try to take the template with the summary of the calculation for the free cash flow. It's enough. Maybe it's not necessary to explain all the details of all the calculation, because it's going to be maybe a little bit too technical, and so you will lose attention of people. Try to make it like synthetic and interesting to follow. And of course, it's not about calculations, but really how you are able to build up the calculation of the NPV, and to tell a story about it. This is really what is important. So of course, what's going to be different this year is that you're going to present through Zoom, right? So I think it's not a problem, because everyone can take the lead in terms of talking and everything. Of course, you should choose one person in the group that shows the PowerPoint document and the Excel file. As you can see, maybe you understood that, but what I show to you guys when I show you the slides, it's not the PDF, it's not the PowerPoint document, it's a PDF document. I do that usually because I think it's easier to manipulate. Because when you go with a PowerPoint document and so on, it's maybe more complicated. But if you want to do animations and everything, of course, you will have to do PowerPoint. I think it works. So maybe one person would be responsible for the document, showing the document and having the Excel file. And hopefully, maybe we have at least each person of the group who's speaking a little bit. So you can split the parts between you guys. And so we will go from one person to the other. Also, I think it's important that during the presentation, at least the members of the group keep the video on, and okay, they cut the mic, or they only open the mic when they talk. So this is what we can say also. So we can see you more and discuss more about this. So this is what I'm thinking of. Do you have any question about everything? One question, please. Yes. Income tax rate and the tax rate used for salvage value are the same or different from each other? See, they have the same value, 40% in your calculation. Yes, for what I took the same percentage. I think this is how it goes in France and in the US. I don't know for Vietnam, but of course, usually students, they use the tax rate, Vietnamese tax rate, in their calculation of the NPV, because what I really would like is that you choose a local project, right? You think about something and you make it personal. It's important that you use Vietnamese data. And so I guess that would be 25% or something like this, or 20% in your case. The sales volume can be can be various among 3 years. Is that correct? Yes, it could be a good idea to do so. The only problem that you can have in that case is that if you do your sensitivity analysis, my advice is that, okay, let's go for Excel. Okay, so you have this, right? So for this, so we have, so I come back to 260 here. So we get the 527. So we say that if we change 110, you can see that it changes everything here, right? Hien, sorry. So we can see that we consider that what is blue is the assumption, and this one is only a consequence of it. Okay. So if you decide to say that your quantity vary, what I would do is that I would do a percentage. Okay, I would do a percentage. So you say that, for example, you're gonna have 20% of the quantity the first year, 35% of the quantity the second year, and 45% of the quantity the last year. And my average quantity is 100. So when you have this, okay, you're gonna have this something like this. And this one. And so here, let's say that you have 300, okay? And so you can see the quantity, which is different from one year to the other, but you can, if you change this one, it changes all the quantity. So it gives you the opportunity to have different quantities from one year to the other, but by changing only one parameter here, you can make your sensitivity analysis. Okay, so this is so yes, you can change the quantity from one year to the other, but try to make it a percentage of the total quantity you want to sell for the entire project. Can we calculate for more than 3 years, such as 4 years and 5 years? Yes, of course you can. Dong, the only thing is that just keep in mind that if you have a lot of columns, maybe it's going to be not so easy to show to someone on an Excel file or something like this. So of course, yeah, usually really don't worry about that. Every year, some students, they have 4 or 5 years in their project. So you do what you want. If you think it's more coherent for your project, go for it. If I do the sensitivity, I will make assumption of minimum volume each year or minimum of total year volume. Yeah, actually, you know what, Ian, I can feel that you have already things which are clear in your mind. So maybe we don't share that with the other people. So it's going to be your one of the things which is original with your project. Okay, so you don't say more, you go, and anywhere we'll go in groups. Yes, don't give your ideas to the other people. And so, so I will go in groups anyway. So we can discuss the particularities of your different projects when I go in the groups. Okay. So what I will do is that I will go from one group to the other. And I will ask, what is your project? Okay, to check if it's already quite clear for you. Okay, and if I can feel that it's okay, I'll let you go, and I will come see you back tomorrow. I have not shown my ace. Yeah. You keep it for yourself. Keep it for yourself. The competition has already begun between you guys. It's fun. It's going to be fun. It's usually fun. For me, it's very interesting because usually Vietnamese projects, so I know I get to learn more about the economical context, and usually this is a moment when you don't listen to me, but you talk and you are proactive. So I think it's going to be fun. It's usually fun. Let's make it fun, serious and fun.